I'm going to cover the top 6 dividend ETF or exchange traded funds that have more than a 5% yield and where they've also been around for at least 5 years. These are not dividend traps, and I'm only reviewing funds that have had consistent growth in their stock price over time. Now, because I'm only reviewing funds with dividends over 5% and older than 5 years, then a lot of the more famous funds like GCOW and SCHD, well, they didn't make this list. And as a quick reminder, dividends are profits from an individual company where the leadership has decided to pay out some of the profits to each of the shareholders. It's a dollar amount per share, and that is divided into the share price to give you the dividend yield as an annual percentage. And these can be paid out quarterly, monthly, or even once a year. Let's get things started with a little bit of a quiz on dividend. Let's say that a fund has a 5% annual dividend yield that's paid out monthly. How much does that pay you each month on a $100 investment? Is it 5 cents, 42 cents, or $5 each month in dividends? Now, I'm not really going to give you much time to think about it, because the answer happens to be 42 cents. Since the annual percentage yield is 5%, then it is a total of $5 added up at the end of the year. That means you need to divide $5 by 12, the number of months, to give you 41.6 cents per month. Now, I happen to know that 30% of you need to see this because I ran a quiz last week with over 1,000 participants, where 29% of you had it wrong, and 71% of you were right on the money. And I want to help that 29% of you to learn a little bit more about the reality of investing in dividend stocks and funds. And that's why I often cover the basics in all of my videos. Adding yet another quiz, let's see if I can stump a few more of you. Let's say that you have a dividend ETF that has a total annual return of 10% and it has a 3% dividend yield. That does not mean that you get a 13% return. That total return of 10%, well, it already assumes the 3% dividend is included. Regardless of its payout frequency, it is to be reinvested into the fund and part of that total return. And the results of that survey had 40% having it correct, and that leaves 60% having it completely wrong. I bring this up in almost all of my dividend videos because I truly want everyone to be more knowledgeable. I guarantee you there will be a few people that are shouting in all caps in the comments, I am completely wrong, and that I need to do the math. I can assure you that I have done the math, and I simply don't want anyone to make that type of mistake. I genuinely want to help those people in particular. Now, before I start the list, I do want to let you know that at the end of this video, I'll be running a back test on these funds to compare it against a benchmark fund. And I'll also list how each fund overlaps their holdings to show how similar or different they are. So you'll probably want to stick around for that. Enough already with the basics. Let's see the list. The first fund is the Franklin International Low Volatility High Dividend Index with the symbol LVHI, where the strategy aims for a stable yield from excluding US stocks, selected and weighted to emphasize profitability, high dividends, low price volatility, and low earnings volatility. It happens to be a very smart approach on paper, and it looks to be playing out pretty well in the fund. And in looking in the holdings, they do have a lot of mid to large cap companies like Mercedes-Benz, Tesco, and Novartis, which are all quality companies, where the expense ratio is at 0.4%, and the dividend is at 6.64%, which definitely makes the cutoff for my list of ETFs with dividends over 5%. But I want to show something interesting about the dividend payout. The highest dividend is paid out in June, and then again in December, and then June, and then December again. And this is a fund that pays its dividends quarterly. Now, if you are a highly disciplined person, you could probably utilize a dividend capture strategy to buy before the ex-dividend date and then sell them after the ex-dividend date. Me personally, I am not disciplined enough to do that. But given the cycles of this fund, it's an easy one to use that sort of strategy on. When we look at the performance of LVHI, the trailing 12, 3-year, and the 5-year compounded annual growth rates are over 16 and 9% respectively. And given its healthy dividend over 6%, I always want to see the price CAGR, like the one at the 5-year, being positive and over 3%. That means that the fund price isn't losing value. And I also like seeing that the dividend CAGR over 5 years is positive and growing. You'll notice the 12-month dividend is negative, and that's because the dividend cycle that I happened to show earlier, where it spikes in June and again in December, well, it just happens to be in the valley right now. And when we look at analyst forecasts, they have LVHI having over 12% upside for the next 12 months. Overall, this is a decent dividend fund that provides an international exposure while showing positive pricing growth over time. The next fund is the 𝐓𝐨𝐩 Global Cash Cow's Dividend UCITS ETF with the symbol GCOW or GCOW, where it focuses on developed markets with large cap stocks, selected by free cash flow yield and dividend yield, where they are weighted by aggregate dividends. And they also weed out REITs altogether, which creates a very interesting list of companies in the holdings from the likes of Bristol Myers Squibb to AbbVie and Gilead Sciences, where I do need to call out the beta as only being 0.69. And as a reminder, the beta is the measure of the volatility compared to the market. So in this case, a beta of a 0.69 indicates a slight correlation to the market and a lower volatility, which that happens to be a good thing. This fund also has an expense ratio of 0.6%, and a dividend yield of 5.98%, which is a pretty healthy dividend that's paid out quarterly. And when we look at the 5-year dividend payout, it has a similar spike in quarterly dividends, but it has the big payout each September. And in looking at the performance, this is exactly what I like to see, a lot of green. The trailing 12 months is over 11%, and both the 3 and the 5-year CAGRs are over 9%. And the top and bottom lines representing the pricing CAGR and the dividend growth CAGR, well, they've all shown consistent growth over time, and analysts are forecasting upside for the next year at over 10% for this fund. Given that it has a great dividend at almost 6% and the beta is fairly low for volatility, this fund truly lives up to its name as a cash cow. I have to say, the hardest part about dividend investments is keeping track of my distributions, the timing, and of course the performance relative to my portfolio. And like most of you, I've tried doing it in a spreadsheet, but whenever there's a change, it just can't keep up. But check out this thing of beauty, where I have visibility to all my accounts all in one place. And this is all thanks to today's sponsor, Snowball Analytics, where they have a site dedicated to helping me keep track of all my multiple portfolios by adding them manually or importing them automatically. I love how the site specifically calls out my passive income from dividend yields. And check out the day gainers and losers from my portfolio. And one of the best parts is the future payments listed from dividends by month as a chart or in the calendar view. And when we look at the analytics, it breaks down each stock and fund's total performance within my portfolio. And if I need a little inspiration, I can check out the community of investors to see what they have for investments and performance. If you're interested, check out the link down in the description for Snowball Analytics, where I also have a promo code for 10% off. The next fund is the InfraCap MLP ETF, with the symbol AMZA, where this fund is actively managed, and it invests in midstream MLPs that collect, process, and store energy products. This fund is a little bit different from most others being actively managed, but this is also the only one of the group that pays out the dividends monthly. And of course, being actively managed, it does come with a lofty expense ratio of 2.18%, which is also the highest of the group by about 4 times. And this is where I take a step back and I remind you that the expense ratio is taken into account with the total returns. And to help make up for it, the dividend is one of the highest at 7.54%. And when we look at the performance, the trailing 12 months is great at over 28%, and the 3-year CAGR is also pretty good at 25%. But it looks pretty dicey at that 5-year mark, where the total return is over 8%, but the price CAGR has a negative 3%. And the dividend CAGR is also negative 22%. So let's dive into this a little bit further. When we look at the 5-year dividend payout, we can see that it was paying at around 80 cents, and then suddenly they changed their payments to around 20 cents, and they kept it at that level going forward. To me, this is actually a good sign to see that they made a fundamental change, and it isn't changing every year erratically. But hey, that's why we dig into these funds, so we can see exactly what's going on. The next fund on the list is the 𝐓𝐨𝐻 Foreign Shareholder Yield ETF with the symbol FYLD, where this fund is also actively managed and seeks funds outside of the US, and it has guardrails for the fundamentals and the technicals, allowing only the top 100 stocks on the list. And they happen to have a 15% cap by country concentration and a 20% cap on sector concentration. And in looking at the holdings, they are an array of companies where I only recognize a few, like the camera lens manufacturer of Tamron and BP or British Petroleum. And even though it's actively managed, the expense ratio isn't horrible at 0.59%, and the dividend is pretty decent at 5.48%. And when we double click into the dividend payout over 5 years, it's pretty obvious that it spikes every June. And the performance, well, it's pretty good at 15% for the trailing 12 and a bit low at 4.6% for the 3-year CAGR, and the 5-year is a solid 10.8%. As for analysts, They forecast the next year with over 14% upside for the fund of FYLD. I like the fact that this is another steady fund with a beta that happens to be in the low volatility range. This next fund, well, it's going to be my polarizing one of the group, and that is the Global X Uranium ETF with the symbol URA. And I believe that most everyone knows that uranium is the driving element behind atomic energy production, where the holdings list out companies specific to mining and engineering purposes of that ore. And the reason that I see this as a strong potential for the fund ties right back to artificial intelligence and the boom in that area is seeing within technology. And the reason why is because the massive increase in servers and GPUs, well, it creates an even larger burden on our already stressed energy grid and power consumption. There is and will be an overwhelming hunger for more power production, and there are a lot of companies researching new technology for small modular reactors and completely new nuclear technology, including what Bill Gates is investing in. The URA fund has an expense ratio of 0.69%, and the dividend is one of the highest ones at 6.78%. And in looking at the performance, it has one of the best track records at the trailing 12, 3, and the 5-year CAGRs, where the 5-year CAGR is had over 23%, which is pretty incredible. And the dividend growth is also very consistent. The year-to-date number is a bit down, and analysts have a lot of expectations for upside, where it is showing over 30% goodness based on analyst predictions. This might be one of those sleeping giants that begins to see a lot of life once the interest rates go down and companies can afford to borrow and build up their infrastructure. The next fund is Invesco S&P Midcap Quality ETF with the symbol XMHQ, where it ties into the S&P Midcap 400 Index, where approximately 80 top-scoring stocks based on the market cap and quality scores are accepted. And the holdings are with a lot of top companies like Williams-Sonoma, Graco, and Dick's Sporting Goods, where the expense ratio is the lowest of the group at 0.25%, and the dividend barely makes the cutoff at 5.06%. But when we dive deeper, because, well, that's what I do, you'll notice that the dividend yield historically had been around 2% and only recently bumped it up above the 5% threshold. Look, I'm not sure if that will be consistent or not, but you do need to be aware of it as it could easily drop down to 2% next year. The good thing is that the performance year to date is over 23%, and the 5-year CAGR, well, it happens to be over 17%, which is quite good, where analyst forecasts have the fund of XMHQ at over 12% upside for the next 12 months. Now I want to shift gears and do a back test of these set of funds against a benchmark to see how exactly it compares. Before I do that, let's take a minute to see how these funds overlap in their holdings. Now, I have to state that I certainly don't advocate that a person invest in every single one of the funds that I reviewed, but if you did, then there is very little overlap among the funds. The biggest overlap is between LVHI and GCOW at 19.2%. And the funds of URA and XMHQ, well, they happen to have zero overlap with all the other funds. Honestly, this is a very surprisingly diverse group of funds where I didn't plan that in advance. Now, I want to shift gears a little bit and do a back test of these set of funds against a benchmark to see how it compares. Now, I'm going into the Snowball Analytics software I talked about earlier, and I'm creating this portfolio. And then I'm testing it over the past 4 years against GCOW. And I'm assuming that I'm not reinvesting the dividends simply because, well, let's say that I'm retired and I'm taking them out to live off of my $1 million investment. And it looks like this portfolio outperformed GCOW, where its balance was 1.6 million versus GCOW's 1.1 million. But my dividends received from this portfolio is quite a bit lower at 309,000 versus GCOW's 401,000. But when we compare the overall net performance, well, the portfolio looks to be better. And when we look at the dividend tab, wow, it shows that we would be getting $99,000 a year to date from this particular investment with a 6.32% yield. And it does break it out down below by month when each payment would be hitting. This type of view is invaluable when you're relying on your dividends for living expenses. Okay, but what if we compare this against a growth fund like 𝐓𝐸? And the cool thing is, you can compare this against any fund that you want to as a benchmark. And wow, it surprisingly beat out 𝐓𝐸 even with the dividends being paid out and not reinvested. Okay, 𝐓𝐸 probably wasn't the best comparison because, well, Cathie Wood doesn't exactly have a great record. Please don't hurt me in the comments. Hey, I hope that you were able to get some value out of today's video. And I also hope that I earned a like from you for my content. And I'd love it if you'd consider subscribing to the channel or even for my free newsletter. Thank you so much for watching.